Hey everyone, welcome to the Fiscal Philosopher. If you're new to the channel, please like and subscribe. We make content about financial and economic concepts broken down into easy to understand tidbits, as well as market updates and how to get the most of your money. We help you learn how to save it, spend it wisely, and invest it. Today we have a super interesting video for you guys about how to qualify for a mortgage. So let's get right into it. No one wants to see you succeed as much as someone who has lent you money. So this basic truth is the bedrock of one of the most important parts of the world economy, real estate and mortgages. So in a mortgage, your house and land are used as security for that loan. But most of the time, your lender does not want to take your house. They want you to do well. They want you to make those monthly payments. They want you to keep on paying them so that you can continue their ability to function as a bank. So if you want a loan, a lender is going to take a deep look at all your finances to make sure that you are worth the risk. So here are some of the things that they're going to think about before they approve you for a mortgage loan. Let's first start talking about the down payment. So in the past, lenders liked a down payment that was equal to 20% of the home's value. But today, there are so many different types of mortgage that have less stringent requirements for a down payment. You gotta be careful with those though, because if you put less money down, your lender is gonna look at you even more closely. Some of you may be wondering why. And it's pretty simple. Because if you haven't put much money into the house, you have so much less to lose if you just stop paying the loan. And for that reason, if you can't put 20% down, most loan types are going to require private mortgage insurance, or PMI, to protect the lender from losing money. There are, however, some types of loans, like VA loans, that do not require PMI. The next factor banks look at when deciding whether to give you a loan or not is the loan-to-value ratio, or LTV. To get to the LTV, you have to divide your loan amount by the home's appraised value. For example, if you're going to buy a home for $100,000, I know, a super unlikely scenario today, but let's just use it for easy math. And your loan is for $70,000. Remember, $100,000 home, $70,000 loan? Your LTV is going to be 70%. So with a 30% down payment, your LTV is never going to be too high. But even if your LTV is 95%, let's say you put 5% down, or you even put 3.5% down, you can still get a loan, though the interest rate will probably be higher. The next piece to consider is debt to income ratios. Because yes, you're going to need income to qualify. So the first thing you're going to look at is your housing ratio, which is just your expected monthly house payment plus the other costs of home ownership. Call it condo fees, whatever you can think of. Divide that amount by how much money you make each month. This gives you the first half of what you need. The second part of what you need is the debt ratio, or the back-end ratio. This takes into account all of your monthly debt payments, your credit cards, student loans, alimony, child support, other houses. You're going to also divide that number by your gross monthly income. Now you're going to have two numbers, or two ratios for debt. In general, your front-end ratio, or your housing ratio, should be under 28%. In fact, from a budgeting perspective, your housing costs should be under 30% of your gross monthly income. And the back ratio, or your debt ratio, shouldn't be more than 36%, ideally under 40%. However, these guidelines can vary wildly. A borrower with high income sometimes is able to have ratios between 40 and 50, as long as the income is able to support the house and other factors are going well as well. Of course, with a loan of this size, your lender is going to check your credit. In fact, they're going to check all three: TransUnion, Experian, and Equifax. But they're only going to use the middle of these scores to decide if you qualify. Because in their mind, the borrower is more likely to pay back their loan if their score is high. So how many points are they looking for? So they use the FICO standard, and FICO, if you don't know already, stands for the Fair Isaac Corporation. This is the company that came up with the model that all of these lenders use. You may have seen scores from Credit Karma and other places. Generally, these use a different system, like the Vantage. But on the FICO model, scores can range from 350 to 850. The middle score on the FICO scale is 723, and most A credit lenders require a score of 680 or more. Different lenders, of course, are going to use scores in different ways, but in general, the higher your score, the lower your interest rate will be. Last, but definitely not least, we're going to talk about the automatic system for underwriting. So the days are kind of over when a lender is going to sit you down and talk to you about your loan from start to finish. Generally, the process is going to start with an automated underwriting system. It's a software program that looks at things like your credit scores, your debt ratios, the loan to value, the home values in the area, all of the things we've discussed previously in this video, and you can quickly find out if you qualify for a loan. These systems are used by most lenders to pre-approve borrowers. You still are going to have to tell the system some things, but for the most part, it's just going to take your word for it. Later on in the process, when they're actually trying to give you the loan, you're going to need to be able to provide the proof for what you put in the system. But the system is just going to listen to you. So when looking to give a mortgage, these are the things that lenders look at. The closer you are to their A rating, the smoother the application process is going to be. Now, as a financial advisor, I'm not saying you have to completely change your life in order to get a mortgage. That'd be crazy. But if you want to buy a house in the future, these are the things you're going to have to consider if you want to qualify and smooth out the process for yourself. If you made it to the end of the video, thank you so much for watching. It really helps us continue to make content like this. And of course, like and subscribe. We got a super interesting video for you guys next week. Stay tuned.